Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special report brought to you in association with the Bank of New Zealand. This is our special top 10 charts for 2010, where we look at 10 of the best charts we can find, often provided by the Reserve Bank or the government, and have a dig through them to try and explain what they mean for the economy, for government spending, for debt, for households, interest rates, the economy, all the stuff we love here at interest.co.nz. And this is a cracker of a chart that we've used before and we'll come back to again and again because it tells us a lot about what's happening with mortgage and term deposit rates in New Zealand. It reflects what's happened with the global financial crisis and how it's impacted us in our daily lives, mainly through those interest rates. Now, what this chart shows is the indicative marginal funding costs relative to the official cash rate. So what does that mean? Well, that's the cost of funding for the banks, marginal to what the official cash rate is. And it's important because that marginal cost often gets passed on to borrowers and to lenders, term depositors, from the banks. So when that marginal funding cost is low, then often interest rates will be lower than would otherwise be the case. And we all remember those days, those glory days back in 2004, 5, 6, when interest rates, particularly fixed mortgage rates, were relatively low compared to the official cash rate, often only maybe 2%, 1.5% above the official cash rate. Then the global financial crisis hit in late 2008, and you can see that that bar above the official cash rate started to blow out. The cost, that marginal funding cost, started to rise. A couple of reasons for that. It wasn't so easy for the banks to go into the international funding markets and get that cheap, hot money. And also, it was more expensive for them to raise term deposits from here in New Zealand. That's partly because the Reserve Bank started pushing the banks to look for more mature funding sources, less vulnerable to disruption on financial markets, the sort of disruption we saw after the collapse of Lehman Brothers. And those funding costs, which some people thought would only last 6 months, a year or so, haven't actually fallen. They're still up around that 150 basis point mark. So that means that fixed mortgage rates in particular, but also floating rates, are around about the 3.5% more than the official cash rate. And you can see that at the moment the official cash rate is about 3%, floating rate is around about 6.2%, and you're also seeing fixed rates around that 6.5, 6.6% mark. And it's unlikely those funding costs will come down too much in the near future, although there is some smidgen of hope. And that's because some of the banks have started raising cheap funding overseas again, really cheap funding, through covered bond issues. And that's interesting. BNZ, for example, was able to raise more than $1 billion of covered bonds at 3.1%. That's much cheaper than other cases. So that may help squeeze down those funding costs a bit, but it's only really at the margin. And it's something that we'll see play out over the next year or two as those funding costs continue to remain relatively high and interest rates relative to the official cash rate remain relatively high. I'm Bernard Hickey. That was the 7th in our series of the top 10 charts for 2010, brought to you in association with Bank of New Zealand.